Okay, so this is going to be an effective yield concept that we are going to discuss from question number 11. And basically, we will be calculating the return of an investor on an annual basis. So, first few questions will be the direct question, and the last question will be on a reverse mode. So, out of 4 or 5 questions, we are going to just discuss on an average 2 questions, first one and the last one most probably. So, whatever I'm discussing in the first question, please focus carefully, because consider this as we are discussing 3 questions at a time. Mr. A has invested in 3 mutual funds schemes as per the details given below. One person, one investor, 3 different schemes. The date of investment is like this, and focus on months here. November 2015, and that to the start of the November. February 2016, March 2016. Okay. Amount of investment in each type of mutual funds, net asset value at entry date. So this is going to be the value price at which you purchased some units. The number of units are not given in the question. You can easily calculate it by dividing 1 lakh by 10.3, 2 lakh divided by 10, and 2 lakh divided by 10.10. Dividend received up to 31st March 2016. So all the dates of starting date is different for all the schemes, but the ending date is same for all the scheme, which is 31st March 2016. Getting it? 31st March 16. So at the very first instance, you can calculate the number of months or days. You can see from November, December, and 3 months, 5 months are here. And from this date, February entirely for mutual fund B. For if we look at mutual fund B, we will cover February and March. That's 2 months, and this is only 1 month. But it is more preferable to solve this type of question taking number of days if nothing is mentioned in the question. So if we calculate the number of days, it will be like this. See, November, December, Jan, Feb, March. November 30, 31, 31. February, it will be 28 if it's not a leap year. So 2016 divided by 4 is a whole number. So it's a leap year 2016. We will take 29 days in February and 31 days in March. Okay, so if we count for the days of all the 5 months, it will be 30 plus 31 plus 31 plus 29 plus 31. So that goes to 152 days in this case. And in mutual fund B, it will be 29 plus 31, that is 60 days, and in this 31 days only. Okay, so this is the net asset value. Dividend received up to 31st March. NAV as on 31st March 2016. So closing, opening, the difference between these two will give you the capital appreciation, and dividend income is already given to you. There is no capital gain separately given. So the difference between these two, capital appreciation plus dividend, will give you the total return in the numerator. But please understand, NAV are given on per unit basis and dividends are given on the total basis. So what you have to do is capital appreciation divided by number of units. This is going to be the total capital appreciation plus total dividend in the numerator divided by amount of investment will give you the return for that much of the period. It will be only called as holding period return. Return only for the period you have held these mutual fund units. Okay, so the very first thing I think you should calculate is the number of units. You can clearly see here that we need number of units, right? Okay, now what is given? Take 365 days in a year. Okay, show the amount of rupees up to 2 decimal points. Please understand this. You need to follow this. You are required to find out the effective yield up to 3 decimal. See, if there is a figure in rupees, take it up to 2 decimals. If there is a figure in percentage, take it up to 3 decimals. On per annum basis, you just don't have to calculate holding period return. Once you calculate the holding period return, convert that into per annum basis. So multiplied by 365 and divided by holding period days. Days for the period you have held those units. Okay. In respect of each of the mutual fund scheme up to 31st March 2016. So have a look on this. The question is very simple and the answer will be like this, but they have given it in the table format. First look at the formula. This is going to be holding period return, which is very simple. NAV 1 minus NAV 0, that will give you capital appreciation per unit multiplied by the number of units plus dividend. There is no capital gain, so do not take it. Divided by the total investment, because in the numerator you have the income on all the units, so the investment should also be based on all the units. This will give you holding period return. Okay, when you multiply this holding period return, first what are you going to do? You are going to divide this by holding period days, for the days that you have held this much of the units. So that will convert your return into per day return, and then you multiply it by the 365 and you will get the annual return, or we can say effective yield. That's it. This is going to be your formula, but they have not used in a formula basis. They have calculated the answer in a table format. You can do whatever you think fit. You can do it like this also, you can do it like that also. Let's first find out the answer according to the table. See, investment, opening NAV, the very first thing that they have calculated is the number of unit. These two things are given to you. You have calculated the number of unit. Okay. Then this is the unit NAV as on 31st March 2016. Right? This is the closing NAV. This is the opening NAV. And this is the total NAV on 31st March 2016. So instead of first calculating the capital appreciation on per unit basis, they have calculated the net assets on the closing value itself. So now this figure is important, and this figure is important for you to calculate the capital appreciation, the investment, opening value and the closing value. The difference between this opening value and the closing value, that means A minus E, am I right? A minus E will give you the increase or decrease on NAV, that will be called as the capital appreciation. In that capital appreciation, you will add dividend, and that will give you total yield, F plus G, total yield. This total yield will be divided by the investment at the end to find out the answer. So this H, see, this total return divided by the investment will give you this effective yield. So effective yield on a per annum basis will be like this. See, total yield H divided by investment. This entire figure in the numerator is the total yield divided by the investment. Okay. Then divided by I. I means the number of days for which you have held the units. This is called as holding period days. So this is our holding period days. I. In the numerator, holding period return. That will automatically be calculated. Okay. Then 365 multiplied by 365. That's it. The same formula that they have used. You can do it by your own also. There is no big deal in this question. The only thing that you had to remember is whether the days are correct or not, because it was a leap year. 152, 60 and 31 will be the answer. 152, 60 and 31 will be the answer. It was a leap year. That's why. How to find out a leap year? Any year when divided by 4, if it gives a whole number, not in decimal, whole number, then it will be called as a leap year, where the February will have 29 days. Okay. Also make sure that these two things are followed. Rupees in decimals 2 decimal, percentage in 3 decimal. So percentage in 3 decimals and rupees are always given in 2 decimals. You can clearly see at any point of time. Are you getting this? Do you think this question is very difficult for you? No, sir. This is an investor's return followed by the simple formula that we have learned in the first question itself. The only difference is this entire return, when you calculate, becomes the holding period return. The return for 180 days or 31 days or 90 days or 60 days. Then you have to divide it by the number of days for which you have held it. That will convert this return into per day return. And then when per day return is multiplied with 365, it becomes the annual return. Getting it? Okay, come over to the question. This is the same question. You can see the date of investment, amount of investment, and the net asset value at entry date. When you are going to divide the amount of investment by the NAV, you will get the number of units. Okay, this number of units when multiplied with the closing NAV will give you the closing value. Okay, that closing value and the amount of investment will give you the capital appreciation. Are you getting it? See, I will just solve one and move on. Let's go for the scheme A. So we have invested 5 lakh rupees. 5 lakh divided by 10.50 means this is the number of unit that we have purchased, 47619.05. Now when I multiply this with 10.40 closing NAV, I will get the closing value that comes to 495 238. Okay, when you calculate the difference between A and B, you will get the capital appreciation. You are going to add that capital appreciation in the dividend, then divide this capital appreciation and dividend by investment that you have made at the first instance, that is amount of investment. This entire return will become the return for the days you have held those units. See, the closing date is to 31st March 2019. So if you come across the starting date, it becomes December has 31 days, January 31, February 28 in this year, and March 31. So it becomes 121 days. For this it becomes 31 plus 31 plus 31 plus 31 plus 28, 90 days. And for this it becomes 31 days. So what are you going to do? Let's calculate the capital appreciation. 5 lakh 495 238 minus 5 lakh. So there is a capital loss of 4762. Have a look. The capital loss of 4762 at dividend of 9500, the total yield will be means the total gain is 4738. So this is the return. In the numerator put the investment, in the denominator that is 5 lakh. So this becomes into 100. 0.9476% is the return for how much, how many days? 121 days. The only thing that you have to do is divide it by 121 multiplied by 365 to convert it into percentage. Have a look. You have to take 365 days. Okay, calculate effective yield on per annum basis, and that's it. Up to 3 decimal, final answer should be. See the answer. Look at the answer. So this is the number of unit. This number of unit when multiplied with the closing NAV will give you the closing net asset value. So this A and E, the difference between the opening and the closing will give you the increase or decrease in NAV, that is called as capital appreciation. This will be added in the dividend to give you total yield. This is the total yield, and this is the number of days for which you have held those units. And then this is the formula. The formula is similar. Simple formula, sir. There is no difficulty. Keep no difficulty in understanding the formula. Forget about whatever is written here. How to calculate the return? It's very simple, sir. Put all the types of return in the numerator and investment in the denominator. In our question, there are two types of return only: capital appreciation and dividend. Divided by investment, this is going to be the return for this much number of days. So multiply it by 365 divided by the number of days for which you have held those units, and then multiply it by 100 to convert it into percentage. You get the answers. What is the comment? Since the effective yield in scheme C is negative and the scheme A is much lower than scheme B, it is advised that Mr. K should redeem the investment in scheme A and C, and the proceeds should be invested in scheme B for the next period. It's very simple. See, you are getting a good return in scheme B and worst returns in scheme C. There is a loss in scheme C and scheme A return is very low. So what is suggested is that you divest, or we can say you sell off all the units of scheme A and C and then invest the entire amount in scheme B, at least for the next period. So that's the question is. Again, this is going to be the same question, so I will keep this as for homework. I don't think so it is now difficult for you to solve it. The format is different. I will suggest you not to follow this format. The previous two formats were lot easier than this type of format. Okay, now here you are going to enjoy, because this is a reverse type of question. Reverse means in this question the effective yield is already given to you and you will have to find out other things. So let's start with this question. Mr. Y has invested in 3 different mutual funds as per the following details. See, the amount of investment is given to us, net asset value at the time of purchase. So with these two figures, what do you think we can calculate? If we divide 2 lakhs by 10.3 in mutual fund X, we will get the number of units that we have purchased. Okay, so what will be the number of unit? Let me just calculate. 19417.48, then 4 lakh divided by 10.10, 39603.96, and this will be 20,000. Okay, these are the number of units that has been purchased. Dividend received up to 31st March 2018. Okay, this is the dividend that has been received. And NAV as on 31st March 2018. When you multiply the units with NAV, you will get the closing value. Minus amount of investment, you will get the capital appreciation. Okay, that capital appreciation when added to the dividend will give you total yield. So the number of units in each scheme has been calculated by us. Total NAV means the net assets on closing. Please write down. The meaning of this question is that, because otherwise everything else is given. Opening NAV is given, closing NAV is given, starting investment is given. The only thing which is not given in the net assets is the closing net assets, which can be easily calculated as NAV1 means the closing NAV into the number of units that you have purchased in the beginning, N0. Okay, number of units is very simple. Total investment divided by NAV 0, the opening NAV. So this is the answer for the first part. Okay, total NAV. When you multiply this 19417 with the closing NAV, 19417.48 with the closing NAV 10.25, you will get 199,029.17. This is going to be the answer for the second part. Now the third part, total yield. Total yield is nothing but capital appreciation plus dividend. So how to calculate? Dividend is already given to us. How to calculate capital appreciation? Sir, this figure 199,029 minus the initial investment will give you capital appreciation. Add dividend in that and that will give you total yield. So total yield will be ready. The last picture is number of days the investment held. For how many days you have held those investment, because effective yield on per annum basis is given to you 31st March 2018, and that's the point where we need to apply brain. So let me just confirm the first 3 parts. This is the number of unit. These number of unit when multiplied with the closing NAV will give you the net assets, and total yield is nothing but capital yield by plus dividend yield. This is the capital yield and the dividend yield. Capital yield is the closing value minus opening value. So this is the capital loss in most of the cases. So this is total yield. See, this is not required basically to calculate because all the 3 funds are different. Now this is going to be an interesting part. Number of days. And that's very easy to calculate. Let me tell you one thing. The only thing that you have to do is keep the data in this format and you will get the answer. Let's just do it. This is question number 14, I think. And what will be the formula for effective yield on per annum basis? It's very simple. NAV 1 minus NAV 0. So net assets at the closing minus net assets at the beginning plus dividend. We can multiply N0 with this plus dividend divided by investment. This is holding period return divided by holding period days. That's what we have to calculate. 365 into 100. So have a look. We'll just try solving first part. What is the effective yield for the first part? It is 9.66%. So what I'm going to do, write down 9.66 on this side. What are the closing NAVs? 10.25 and 10.30. So can I write it like this? 10.25 minus 10.30 into the number of units. In the first part is 19417.48 plus dividend 6000 divided by investment. How much? 2 lakhs into 365 holding period days into 100. See, now we can easily solve this equation. I will show you. Just have a look. See. So in the calculator, we are going to start with this figure. See, 10.25 minus 10.30, 10.25 minus 10.30. Then I will multiply it with the numbers 417.48, the number of units. This is the capital loss. It's not a capital appreciation, it's actually a capital loss to us. Just a second. Yeah. It's actually a capital loss to us, 970 point something. In that we are going to add the dividend of 6000 rupees. So this is the total yield 5029. I think we have this in our question here as well. See, 5029. You can clearly see this. This 5029 will then be divided with the total investment of 2 lakhs. So divided by 2 lakhs. This is your return. This is your holding period return. Okay, that's comfortable. Now you multiply it with the 365. We can clearly see it there, 365. Then multiply it by 100. You can see it at the end. And then what will happen? This is the answer. See, 917.81. So this is 9.66 on this side and 917.8155 divided by holding period days. Now what you have to do is you just have to simply shift this holding period days on that side and you will have some answer divided by 9.66. So the answer is 95 days. So that is 0.011 is just because of some rounding off error. So 95 days is the holding period days, but that's not what the question is asking. Question is asking, okay, for number of days only. So question is asking you the number of days only, but with that number of days you can easily calculate. Just a second. With that number of days you can easily calculate the date of original investment. You can go back 95 days and you will have a date of original investment, the date when you invested, because the closing date is 31st March 2018 for all. 31st March 2018. So you have to go back 95 days from this. 95 days from this date. Okay. So in this way you can calculate for mutual fund Y, also for mutual fund Z, the period of holding. And based on that you can calculate the date of original investment as well. Okay, let's move ahead to the next question now. Question number 15, 16, 17, 18 and 19. These 5 questions are based on the similar concept. Let's just go through the concept sheet. to have an idea about it. So if you will see, if we go from 15, 16, 17, 18 and 19, all these 5 questions are based on the dividend reinvestment, bonus plan and growth plan. So what I'm going to do, I'm going to just take 17, 18 and 19 because 17 includes dividend reinvestment, bonus and growth plan. Out of these 3 plans, the 2 plans has been covered in this 15 and 16. So that's why 15 and 16 will be your homework, and these 2 will be taken by me because these are based on the reverse calculation methodology. In these 5 questions also, we are going to calculate the yield of the investor, the how much investor is earning. So most of the questions from the starting till question number 19 are based on the earnings of the investor who is investing in the mutual fund. But after this point, from question number 20 onwards, we will be focusing from the mutual funds angle, the net asset value. Okay. So let's have a look on question number 17. See, Cinderella mutual fund. So focus on this question as we are solving 3 questions at a time, 15, 16 and 17. Cinderella mutual fund, an approved mutual fund sponsored open-ended equity oriented scheme. The name of the scheme is Rudolph Opportunity Fund, and under that there are 3 different plans. There are 3 plans under this scheme. Plan A, dividend reinvestment plan, means whenever the dividend will be declared by the mutual fund, it will be reinvested back in the fund itself. So you are not going to get the dividend in your hand. So what exactly you are going to receive in meanwhile? You are going to receive additional units at the ongoing net asset value. Suppose you are investing in the mutual fund today, and after a year or 2, the dividend of, let's say, 10,000 rupees is declared by the mutual fund. So that 10,000 rupees at that ongoing NAV will be reinvested back in your name, and you will get the additional units in place of that. So the only point where you will be redeeming, you will be getting the cash is when you will sell all those units. The second plan is the bonus plan, where you will get additional units as a bonus. So there will not be any kind of a dividend in that plan. There will not be focus. They will not focus on the growth also. The main thing that they will focus is on giving you additional units of mutual fund. So if you have started with 10,000 units, you might get 2,000 units in the next year, then again 4,000 units in the next year, and so on. So this is a bonus plan. And the third plan is my favorite plan, that is the growth plan. What happens in the growth plan is they do not focus on the dividend, they do not declare dividend, they do not declare bonus units also. They mainly focus on increasing the wealth. So 10,000 units invested in the beginning remains 10,000 till the end, but the NAV, the net asset value per unit, grows subsequently over a period of time. So you can see in plan ABC, when you are starting, the NAVs are like this. On the very first date which is given in the table, the NAVs are like 30, 31 and 35. But by the end of the period, you can say 4-5 years, this is 53, 22 and 82 rupees. So the growth plan, can you see the NAV of the growth plan? It is 82 rupees. So that's what they are focusing on. You can clearly see that. Okay. At the time of initial public offer on 1/4/2009, Mr. Amit, Mr. Ashish and Mr. Arun, there are 3 direct investors, invested 2 lakh rupees each at a face value of 10 rupees per unit. So at that time they invested at the face value. So face value was the market price itself at the time of IPO on 1/4/2009. So if you are investing at 10 rupees, I think everyone has received 20,000 units. Okay. And chosen plan B, C and A respectively. So for Mr. Amit, B, C, Mr. Ashish and A, Mr. Arun. Okay. The particulars of the fund over the period are as follows. You can see here. Yeah. So these are the dates given to you. The dividend declared by the dividend plan. So this is related to plan A only. Bonus is related to plan B only, and there is nothing for the plan C because the only objective of plan C is to increase the NAV. So this is the dividend percentage. This is the bonus ratio. These are the plan ABC's net asset value. And on 31st July 2019, all the three investors redeemed, sold all the balance units. Consider the following. Long-term capital gain is exempt from income tax. Short-term capital gain is subject to 10% income tax. So when do you call it a long-term? When the securities have been bought and sold, and the gap between the buying and selling of the securities is more than 12 months. It will be covered under long term. And if the buying and selling activity of the same unit happens in less than 12 months, it comes under short term capital gain. Now, securities transaction tax in terms of shares and securities, it is 12 months. I think if you apply the accounts knowledge here, long term and short term, or I think tax knowledge here, then long term and short term in the other assets are for 36 months. I think 36 months is also a slab for the other assets, but for securities it is 12 months. Securities transaction tax is 0.2% only on sale or redemption of units. So when you are buying, there is no STT in this question. Ignore any kind of education cess, and what exactly you are required to do is to calculate the effective yield per annum, that is annual rate of return for each of the investors, and suggest the name of the investor with the highest effective yield per annum with the difference to his nearest investor. This is very easy. We'll focus on that later on. And show your calculation up to 2 decimal points. That's very good. See, so now what exactly you have to do? You have to find out, the very first thing is you have to find out the return, and that too per annum. For that purpose, you need return in the numerator and investment in the denominator. Investment is ready with you, which is 2 lakh rupees. But return, for the purpose of return, you will have to find out how many units of plan A you sold at 31st July 2019, of plan B also, and plan C to same 20,000, but plan A and B will have a different number of units than what has been invested at. So we will have to find that out. One by one we will take every plan, and then we will find out what is exactly the return an investor. The longest we can say will take a maximum time for plan A, and it will take a little less time for plan B, and plan C will be very easy to solve. And this 10%, 35% and 20% dividend will be called as the dividend rate, which will be applicable on the face value only. So make sure that you are not applying it on NAV but on the face value. So one by one we are going to solve. Have a look. Let's start with Mr. Arun, plan A, dividend reinvestment. So there will be certain columns: date, investment, dividend payout ratio, the dividend reinvested, NAV, units and closing unit. One by one we will take it. So at the time of investment, that is on 1/4/2009, we invested around 2 lakh rupees, and it has been clearly written in the question that we have invested at the IPO price face value, which is 10. So the number of unit that we have received is 20,000 rupees. Okay. And after that, from April 2009 to July 2013, nothing happened. No dividend was declared. So if the dividend is not declared, there is no reinvestment. No reinvestment means no additional units. No additional unit means the closing units will remain same. But on 31st July 2013, 10% dividend was declared. So 10% of what? Sir, 20,000 into face value. Face value is 10. The closing number of unit into face value. So that's 2 lakh. 2 lakh into 10% becomes 20,000 rupees. This 20,000 rupees dividend which has been declared is reinvested back on 31st July 2013 And if you are reinvesting 20,000 rupees on this date's NAV will be important, because you will receive additional unit based on this date's NAV, which is 30.70. See, this is 30.70. So you reinvested that thing. Now 30.70 is the NAV. So 20,000 divided by 30.70 will give you the additional units that you are getting. So from this date onwards, you will be having 20,000 plus 651.47, that is 2651.47 number of units, right? Okay. After that, on March 2014, 35% dividend was declared. So understand one thing, 35% dividend is declared on March 2014. So 35% will be applicable on the closing number of units that you are possessing at that point of time multiplied by the face value. So 2651.47 into 10 into 35%. So let me show you the calculation for this. For even if I show you, even if I write it for once now, you will get it for the others as well. So 2651.47 into 10 into 35%. So that goes to 72,280. See, 72,280. So this is the calculation. Getting it? And again, this amount of dividend, 72,000 rupees, will be reinvested back on that date's NAV, which is 58.42. So you will divide 72,280 with 58.42 and you will get this much number of units, which will be added to the previous closing, the previous closing units, which will become 21,888.72. On the next dividend date, you will get a dividend on this much units multiplied by 10 and multiplied by 20%. That will come to 43,777.44 divided by that day's NAV 42.18 will give you the additional units, which will be added by you in the previous or the opening units, which is 21,888.72, with the total of number of unit will become this much, and the story will go on and on like this. The only purpose of doing this is to find out the closing number of units at every point of time, because the number of units are increasing and we have to find out that on the date of selling all the units, how many units we had, right? So the next dividend is 12.5%. What are you going to do? Into 10 into 12.5. Make sure that you are calculating the dividend on face value. This divided by the NAV, that will give you additional units. You will add it in the opening units and this will be the closing number of units. Again multiplied by 10 into the dividend rate 20%. This divided by the dividend divided by the NAV is equal to additional unit and then this and this. So at the end, on 31st July 2019, you sold around 24,522.5 units. You purchased around 20,000 units, but on different dates you started accumulating the units because of the dividend reinvested in the fund. So when you sold all the units, when you redeemed all the units, the NAV, the ongoing NAV was 53.75. So the total selling value comes to 13,18,084. But you will have to pay the securities transaction tax at 0.2% on the redemption value. So the net amount to be received is 13,15,448. Make sure that you are calculating all the working or doing all the working in 2 decimal, because it is written in the question specifically. Now comes the short-term capital gain tax. Do you have to pay any kind of a short-term capital gain tax? Yes, sir. See, you sold all the units on 31st July 2019. So selling date for all the units is the same, but buying date for all the units is different. See, this 20,000 units you purchased on 1/4/2009. 651.47 units you purchased on 31st July 2013. Although you didn't purchase with your own money, but this will be considered as a purchase date because this was the amount that you were supposed to receive. So even if it didn't touch your hand or your bank account, but this is your money which was reinvested back on 31st July 2013. So 651.47 will be deemed to be purchased on July 2013. In the similar manner, if you come to this date, 25th March 2019, you purchased around 978.94 units, which comes under the short-term capital gain tax purview, because in you purchased on March 19 and you sold it on July 19, those 978 units. Before that, if you just go back to the previous purchase date, it comes beyond the 12 months category. It comes in beyond the 12 months category. So 15th March 2018 to 31st July 2019 is around 16 months. So that will be considered long-term capital gain, and all these will be covered under exemption. Long-term capital gain, long-term capital gain, long-term capital gain, long-term capital gain, and this is going to be short-term capital gain. So basically we are going to pay the short-term capital gain tax on the profit of 978.94 unit. How to calculate the profit? See, you purchased those units at 48.10 and you sold it at 53.75. So what are you going to do? You are going to calculate the short-term capital gain tax at 10% on 978 units. Okay, my suggestion to you is, instead of 53.64, take 53.75 itself. 48.10 will become the buying price, 53.75 will become the selling price. Although they have taken 53.64, you might ask this question, right? How did this 53.64 has been arrived? It's very simple. They have removed 0.2% from the selling price because it is to be deducted. But in the direct tax rules, according to the direct tax rules, you do not get the credit or deduction for securities transaction tax paid, and that's why we should not deduct 0.2% while calculating short-term capital gain tax. So 53.75 entirely will become the selling value. I think it might be written, it should have been written somewhere here. It's not. So 53.75 is the correct answer there. 53.75. You do not get the deduction for short-term capital gain tax as securities transaction tax while calculating the short-term capital gain tax. You can just inquire through your direct tax teacher also, or the book if you have it, right? So 53.75 minus 48.10 will become the short-term capital gain for 1 unit. Multiplied by the number of unit 978, it will become the total short-term capital gain, and then multiplied by 10%, it will become the short-term capital gain tax that you will be paying. So let's say this is the amount that you are going with. So in exam, what to do, sir? In exam, you can do this one also, 53.64, 53.75, but the only correct approach is 53.75. Okay. So this is going to be the short-term capital gain tax that you will pay. So at the end, net of tax amount received by you will be 13,14,905. Okay? You will get it in your bank. So you invested around 2 lakh rupees and you have received around 13 lakh 14,000 rupees. So the total profit is 11 lakh 14,905.88. Am I right? Because you didn't pay anything else apart from this 2 lakh rupees. You didn't pay anything else from your pocket. Everything else is the gain for you. But that's not the gain for 1 year. That 11 lakh rupees is not just the gain for 1 year. It is the gain for around 124 months. I will tell you. You started on April 2009 and ended your journey on 31st July 2019. So from April 2009 to April 2019, 10 years. 10 years into 12 months, that is 120 months. Okay, and then entire April of 19, April, May, June, July, 4 more months. So the total investment period will become 124 months. And how to calculate the average return? It's very simple, sir. The formula and the concept will never change. It's very simple. If you want to calculate return, put return in the numerator, investment in the denominator, and this entire return is for 124 months, so divide it by 124 months. The moment you divide it by 124 months, you convert the entire return into 1 month's return, multiplied by 12 means per annum return, that is 53.95 per annum. Did you get that? So this is what the dividend reinvestment plan. What happens in the dividend reinvestment plan is, at different dates the dividend is declared by the mutual fund and the same is reinvested back on that date's NAV to increase the number of units that you are holding in your account. And at the end you sell all those units, and at that time you need to deduct the securities transaction tax. After that, you need to make sure that if there is any short term capital gain, then you pay the tax on that also. If there is any long term capital gain, you pay the tax on that also. In this question, there is no tax on LTCG, but there is a tax on STCG. So that's why we paid 10% on that. Also, the point to remember is that while calculating the short term capital gain tax or long term capital gain tax, you do not get the deduction of securities transaction tax. So institute should improve their answer. Instead of taking 53.64, they should take 53.75 in this calculation. This is the net of tax amount received by you. This was the investment. The difference between these two will be treated as return for 124 months. So divide that return by 124, multiply it by 12 to make it a per annum return. The rest of the two calculation, that is the bonus ratio and growth, is very easy. Let's go on for the bonus ratio calculation, bonus plan. So this is your bonus plan. Mr. Amit is holding the bonus plan. On 1/4/2009, he also invested around 2 lakh rupees at 2 lakh rupees at 10 rupees per unit. So the number of unit that he purchased was 20,000. There is no need for NAV and lots of calculation here, because this is very simple. You started with 20,000 units, right? You started with 20,000 units, and then the bonus was declared directly on 31st March 2014. You can say it is in the ratio of 5:4. That means what? If you are holding 4 units, you will get 5 more units. We were holding around 20,000 units at that date. So how many more units we are supposed to receive as a bonus? 25,000 units. 5:4. Okay. So if you do the calculation, they should have given one more column of ratio, 5:4. Let me just write down 1:3 and 1:4. 1:3 and 1:4. So let's have a look on the calculation. 20,000 divided by 4 multiplied by 5. So this 4, the second number expresses about the current holding, and 5 is the additional units that you will be getting. So this is the bonus unit. 20,000 divided by 4 multiplied by 5. Let me just do the calculation. It will give you 25,000 additional units, and from that date onwards you will have 20,000 of the original units, 25,000 bonus units. The total balance will be 45,000. We do not need this NAV. This is not required. Yeah, this is required only for the purpose of short term and long term capital gain. So let's take it. And then on 2018, the next bonus was declared that if you are holding 3 units, you will get 1 more. And at that date, please understand, we were holding 45,000 units. So 45,000 divided by 3, 15,000 multiplied by 1, 15,000. Getting it? So from that date onwards, we have 60,000 units in our account. And then the last bonus was declared on March 2019. 1:4 was the ratio. So 60,000 divided by 4 into 1, 15,000 additional units. So we have total 75,000 units, which we sold 4 months later. Only 4 months later from the last bonus at 22.98. So 75,000 multiplied by 22.98 is the redemption value, less 0.2% securities transaction tax, net amount received. Obviously, you can see that on March 2018, this comes under long-term capital gain, this comes under long-term capital gain, this comes under short-term capital gain. So we are going to again pay 10% on the short-term capital gain here. Okay. And you can clearly see that the number of units that will be considered under the short term capital gain is 15,000 units. So this 15,000 unit purchased at zero value. For the bonus shares, the purchase or the acquisition cost is considered as zero, not 19.95. This is one mistake in the question also. So this is another ambiguity in the answer by the institute. If you go through the direct tax rules, you will understand that the bonus units that you are receiving will have zero acquisition cost. So purchased at zero value, sold at the redemption price, which is 22.98. So according to me, it should be 22.98 first of all and zero in the second part. I have seen the answer sheets also. When students did this type of treatment, 22.98 minus 0 as the acquisition cost, they got the full marks in that, right? So you can go with the correct treatment. This treatment is wrong. This treatment is also wrong. They should not take 22.93. How did this has been arrived? They have reduced the securities transaction tax from 22.98. So they are basically taking the deduction of this expense before calculating the short term capital gain tax, which is not allowed under the tax rules. So you should not do that. The proper treatment should be 22.98 minus 0. So entire 22.98 will become the short term capital gain. And on that 10% will be paid as 34,470. This will change the entire answer, but we cannot help it. If the question comes in exam, I will suggest you to go according to the institute's answer only. Although they have given the correct answer to the correct treatment as well, they have given full marks to that, but I don't trust institute on such things. So that's why go with the institute's treatment, you will get the marks. So this is the net of tax amount after paying the short term capital gain tax less investment. This is again the same procedure. 15,15,000 becomes the net gain, and that 15,15,000 is the gain for 124 months. So make sure that you are calculating the return, but this return is for 124 months. Divide it by 124 months to convert it into 1 month return, multiply it by 12 to make it a per annum return. This is your final answer. Let's go to Mr. Ashish's plan. It's very simple. We don't have to do any kind of a working in Mr. Ashish because there are no additional units received in between. The number of units that you are purchasing and the number of units that you are selling in the growth plan is same. So that's why we will start directly by selling it. Redemption value 20,000 into 82.07 was the NAV. The entire 20,000 unit will come under the long term capital gain because it has been around 124 months gap in buying and selling. Okay, so the securities transaction tax 0.2%, net amount received, there is no short term capital gain tax, 0, long term capital gain 0, net of tax amount, investment and gain. This is very easy. The growth plan is very easy. The entire gain is 14,38,000 and this will be treated as 69.59% if you convert it into per annum return. So you have all the three answers with you. You can clearly see that the dividend reinvestment plan takes a lot of time to solve. After that, bonus plan and then growth plan is very easy to calculate. Mr. Amit, the bonus plan earns the highest effective yield, 73.33, and the difference to his nearest investor is Mr. Ashish, which is having a growth plan. Alternatively, see, this is very important. See, this has been given by the institute. Figure of star and this can be taken as without net of tax, without net of STT. As per the proviso 5 of section 48 of the Income Tax Act, no deduction of STT shall be allowed in computation of capital gain. So you should not deduct the STT. They have given specifically. Then if the institute is giving it in a note, why they are not giving it in the answer? I will tell you the reason. Because couple of years back, this note was not there and this was the only answer by the institute. Now they cannot change directly and say that we have been solving this question wrong. since last 10 years. They cannot say it. So that's why what they do is they give the alternative answer. But from my angle, this is not the alternative. This is the correct answer. That was the wrong answer. So you follow that now. You go with the correct treatment. You will get the marks. Okay. So in this manner, you are going to solve question number 15 and 16 as well. Question number 18 and 19 is little interesting because here we will have to calculate the gains will be given, I think, and we will have to calculate the beginning NAV at which we invested the units. Let's have a look on this question. Messrs Corpus and Asset Management Company on 1/4/2015 has floated two types of schemes, dividend plan and the bonus plan. Okay. And there is an investor called as Mr. X who invested in both the schemes. The following details are as follows, except the issue price. See, at what price we have or Mr. X has purchased the units, no one knows about this. So this is the date on which the units were purchased, 1/4/2015. This is what you have to find out, the issue price. Every unit has been purchased at a certain price, and that is what the mystery in this case. On 31st December 2016, 1:4 was the ratio of dividend, and this is what the dividend. 1:4 was the bonus ratio, and 12, 10, and 15 is nothing but the dividend declared by the mutual fund. There are some additional details. Investment 9,20,000 and 10 lakh. Average profit is also given to us in terms of rupees and yield. You are required to calculate the issue price of both the schemes as on 1/4/2015. See, investment is made at NAV. Okay, investment is made at NAV, and it's not necessary that the NAV and the face values are same. But if you are making the investment on the very first day or the IPO, then at that time the NAV and face value mostly remains the same. Let's focus on the dividend plan first. And you can see that average profit in the dividend plan is 27,748.60. Start applying your brain. If this is the profit, if I add that profit to 9,20,000, will this be a good idea? No, sir. First of all, this is per annum return. This is per annum return. Average. Don't forget about the word average. Average means for all those years. How many years? Let's calculate that. You might have sold it on 31st March 2020. You started on 1/4/2015. So that goes around 5 years. 5 into 12, that means 60 months of the total data. You can take 5 years or you can take 60 months. So what I'm going to do is I'm going to just multiply it by 5 to bring the total profit on the table. So that's 138,743. If 138,743 is the total profit, can I say that 138,743 plus 9,20,000 is the redemption value? 10,58,743. Can I say this? This much is the redemption value. There are no short-term capital gain tax, long-term capital gain tax, or securities transaction tax. So all the taxes has been removed. See, in the next question, you don't have to worry about this much, this one, or anything else. So basically, whatever the gain is, you can add that back to investment. Just do the reverse calculation. Add the investment in the net gain to arrive at the net of tax amount, and this net of tax and this redemption value will be same because all these data are absent in this question. So redemption value will become the net of tax amount. So now we can calculate by dividing the total redemption value, this amount, by the NAV, we can get how many number of units we have sold on the last day. So can I say 10,58,743 is the total sell value at 49 rupees, the closing NAV. And if we divide it by 49, we will get a figure which is 21,607. These are the closing number of units, 21,607. These are the closing number of units. Now you just have to do one thing. You have to go back with all the dividend dates, because what would have happened on this date, dividend was declared and you received additional dividend which was reinvested back at 48 rupees and you got the additional units. Same thing happened on this date, same thing happened on this date. So you accumulated number of units, you accumulated additional units 3 times to make the total to 21607, to make the total number of units to 21607, which you sold at 49 rupees, became 1058,743, and when you deducted investment out of that, the total return became 138,743. When you divided it by 5, average profit came down to 27,748.60. So this is the whole story. Now how to go from 21607 units to this, to this, to this, and to this date? Now let's understand this beautiful procedure of going step by step backwards, okay, with this figure. Let's have a look on this particular question, question number 18. Now what happens when we declare the dividend? You take the number of units, let's say X, and then you multiply it with the face value. The very first thing on the dividend rate is the face value, which is not given in the question, and that has to be assumed in any case. Without that, you will not be able to solve this question. So we are assuming the face value of rupees 10. That's the basic thing. Every time you have to assume a face value. If the NAVs are around 40-60 rupees also, make sure mutual funds face value assumed is 10 rupees only. So X into the face value. See, I will just create a formula first. Opening units, tell me if I'm right, into face value multiplied by dividend rate. Am I right? This will be the amount of dividend which will be reinvested back. This entire amount of dividend will be reinvested back at that date's NAV. And what will be this answer? This will be the additional units that you will be adding to your opening units, and the total will become closing units. Am I right? Opening units multiplied by face value multiplied by dividend rate. That will be the total dividend received and invested back at that NAV to, and this entire figure will give you the additional units plus opening units is equal to closing units. Okay. If you against wants to go one step back, we can just simply write down that additional units plus opening units is equal to closing units. Happy? And then you put a formula for additional units only. Am I right with this formula for the additional units? Okay. Now let's go a step further. Let's say the opening units is X. The face value is 10. Dividend rate is 15%. So this will be the total dividend which will be reinvested back at that date's NAV, which is nothing but 45 in this row. Okay. So I will just write down 45 plus X is the opening units, and the total should be 21,607. 21,607. With the help of this, we can calculate the opening units. So what is going to happen here? We are going to create a formula for calculating X. That's what we want, right? So this 45 will go in the numerator and it will be multiplied as like this 1.5, or I can just write down X into, let's write down once again, face value into dividend rate plus NAV into X. Am I right? And then divided by NAV. This 45 will go in the numerator here and it will be written as NAV 45X, that is NAV into X. And on this side we can say closing units. Now let's start creating a formula out of this. Let's take X as the common figure, okay, and NAV on that side. So I will just write down face value into dividend rate plus NAV is equal to closing units multiplied by NAV, the denominator. Okay. Now transfer this entire thing on the other side and we will get a formula for X, that is closing units into NAV divided by face value into dividend rate plus NAV. That's it, simply. So how much is the closing units? 21607. The NAV is 45. Face value is 10, dividend rate is 15%, and NAV is 45 again. So if you start solving this equation, 21607 into 45 goes to 972315 divided by 46.5, and you will get the number of units at the beginning, which is 2910. This is X. So we have created a formula, and the formula is this for X, and we have created it with the help of the basic logic only, which is this: additional unit plus opening unit is equal to closing units. We have taken opening units as X and we started putting figures, and this is what we have to apply at every point of time. Closing units multiplied by NAV divided by face value into dividend rate plus NAV. That's it, simple. So have a look. Let's just start doing it. We had 2910 here, 2910. So this becomes the closing units for the previous calculation. Have a look. Closing units multiplied by NAV. NAV of this date is 50. So let's do the calculation. I will just show you here. Have a look. So 2910, let's multiply it with 50 divided by face value. I will just take this. Face value is 10 rupees into dividend rate, which is 10%. So that is 1. 10 rupees into 10% is 1 plus NAV, which is 50. That means 51. So divided by 51, you will get 20,500 as the opening units. 20,500 as the opening units here. Okay. At this place. Now 2500 becomes the closing units for the previous calculation. So 20,500 multiplied by the previous NAV, which is 48. 2500 into 48. Okay. Now divided by 10 rupees is the face value multiplied by 12%, that means 1.2 rupees plus NAV, which is 48. 1.2 plus 48, that is 49.2. So the answer is 20,000. Opening units are 20,000. This is how you solve this entire equation. See, the very first part. Average annual gain over a period of 5 years is 27,748. I'm just revising the entire answer to you. Focus on that. This is the average annual answer. You multiply it with 5, you will get the total return, total gain. You add in that that total gain in the initial investment, you get the total value of investment, closing value at the time of selling. So if you are getting this much of the amount by selling every unit at 49, then the number of units, closing units, were 21,607. This much to we understood already, and then the real game started from this point. You were holding 21,607 units. Now see what is happening, the formula that they are applying. See, 1 divided by 1 means what? 21,607. Okay. You can apply your own one also, but that's okay. So 21,607 divided by 4 plus 5 into 4. That means 1.5, and this is 46.5 into 1.5, 1.53. 21,607 divided by 1.53. That is the additional units now. Okay, forget about it. We are not calculating the additional units. We will directly calculate the opening units. This one, this calculation. I will just write down the formula for this one. What was our formula? Closing units multiplied by NAV divided by face value into dividend rate plus NAV. You start that calculation and you will start getting these figures, 20,000. Okay, so these are the number of units that you have purchased at the beginning, 20,000. By investing how much amount? 9,20,000, right? So 9,20,000 divided by 20,000 will give you the NAV at that point at which you invested. See. So issue price as on 1st April 2015. The dot is missing here. That's why I'm putting a mark. 9,20,000 divided by 20,000, that means 46 is our NAV on that date. Simple enough. This was all about the dividend plan. Let's talk about the bonus plan now. See. Now if we go through the bonus plan, the average yield is 6.40% per annum. If you multiply it by 5, it will be, let's change the color of the pen. So if you multiply it by 5, the total return will be 32%. The total return is 32% on the investment of 10 lakh. That means 3,20,000 rupees is the total gain. And if you add 3,20,000 to 10 lakh, that means the total amount of redemption is 13,20,000. And if you divide 13,20,000 by 44, you will get the closing units. Am I right? That comes to 30,000. And this calculation is very easy, sir. See, 30,000 is the closing units. After this bonus issue. And at that time, what happened? If you were holding 5 units, you received one more. That means it became 6. Earlier it was 5, it became 6. So 30,000 divided by 5 plus 1, 6. 30,000 divided by 6 multiplied by earlier was 5. 30,000 multiplied by 6 by 5. Simple, you will get the previous figure. It was 25,000. You do the calculation now. 25,000 divided by 5. 5,000 into 1, 5,000. So 25 plus 5,000, 30,000. Getting it? So you do the calculation like this. Let's go to this point. 25,000. 25,000 was the number of unit after this issue. And the total issue is 4 earlier. One more bonus. That means multiplied by it should be 5 by 6 multiplied by 4 by 5. Why 5? Because this 25,000 is the units after this one issue. Na? So earlier we had 4, we received one more. So total we should have 5 now. So 25,000 divided by 5, 5,000 multiplied by 4, 20,000. So in this case also the number of units were 20,000 in the beginning. So if you divide 20,000 by 10 lakh, you will get the NAV at the beginning, which is 50 rupees. See, 30,000 multiplied by 5 by 6, 25,000 multiplied by 4 by 5. Simple. Okay, let's move on to the next question now. Question number 19. I hope this question was very good, and mark it as important, because if you solve this, if you are able to solve this question, that means you can solve the previous ones also. Reverse calculation is not an easy task, my friend. Now let's focus on question number 19. And it's a very easy question, not that difficult. Have a look. Messrs Enterprise and Asset Management Company on 1/4/2016 has floated a scheme named as dividend plan. Mr. X, an investor, has invested in the scheme. Dividend is given in the form of the units. That means it was a reinvestment plan. The details except the issue price are as follows. So at 1/4/2016, there was some issue price at which you invested the amount. How much, you don't know. So on 31st March 2018, 19, 20, the dividend was given 20, 25 and 30 rupees. Okay. NAV was also given on 31st March 2021. This was the NAV. Initial investment is this much. Average profit of over 5 years is 54,576. So let's do the calculation. Multiply it by 5. It becomes 272,880. And this is the profit. Add it in the initial investment. The total will be 21,12,880. So this is the amount that you have received after selling all the units at what price? At 49. So divide it by 49. So these are the number of closing units, 43,120. Now what exactly the question is asking us? You are required to calculate the issue price of the scheme on 1/4/2016 to ascertain the capital appreciation. Assume face value of units as 10 rupees. This is very easy question. You have to solve it just like the first part of the previous question. Just like the first part of previous question. So let's start doing it. See, if you do not remember the formula now, this is question number 19, then also it's all fine. You go with the logic and you will get the answer. So what is the logic? Again, sir, additional units plus opening units should be equal to closing units. And how to calculate the additional units? Sir, opening units X into face value into dividend rate reinvested back at that day's NAV in plus opening units, that is X, and this will be your closing, which is 43,120. Am I right? Let's start doing it one by one. Let's put this formula every time and we will calculate the X. So X into 10 into, what is the dividend rate? 30%. And at that date, the NAV was 45 plus X is equal to 43,120. And just calculate it now. 30%. 3x plus 45, 48. So 3x plus 45x is equal to 43,120 into 45. That's 19,40400. X is equal to 19,40400, 48. 4425. Now you take this one as the closing units in the next calculation. Again, write down the formula. X into face value into dividend rate divided by NAV plus X is equal to closing units. Why to do that every time? Because you need to remember it. So don't look at the formula above. Try writing the formula by applying your brain, doing all the calculation in your mind. Now let's put down the figures. X into 10 into, what is the dividend rate now? Dividend rate is 25 and the NAV is 15. 25% NAV is 50 plus X is equal to closing unit is 4425. Are you good with this calculation? So this is going to be 2.5x plus 50x is equal to 4425 into 50. So 52.5x is equal to 2021 to 50 and X is equal to 38,500. Another answer. This was one more calculation to be done. Again, write down the formula. Use your brain. Do not just scroll above and write down. Copy paste. Don't copy paste the formula. You should remember it. So X is the opening unit, face value, dividend rate, NAV plus X, closing units. Start. X into 10 is the face value, dividend rate 20 and NAV 48. 20%. NAV 48 plus X is equal to, how much is the closing units? 38,500. Let's do it. 2x plus 48x is equal to 38,500 into 48. 1848 000. So X is equal to 1848 000 divided by 50. 36,960. What was the question asking us? Question was asking us the issue price. So we invested how much? 18,40,000. 18 lakh. And how much units that we received? 36,960 at the beginning. This becomes 49.78. Am I right? Let's just find out. 1, 2, yeah, and 3. And 49.78 is your final issue price. Did you get that? This question was actually homework. It should have been a homework for you. So question number 19 and 18 are very much similar and you should do it. So these are important ones. If you are able to do it, then you can do all the questions related to that. So question number 20 onwards, we are going to solve after a break. So bye bye for now. So hello everyone, welcome back after the break, and question number 20 is going to be our next question. 21 is very much similar to question number 20. So 21 will be the homework to you. 20 is what we are going to solve in the class. Have a look. A mutual fund raised 150 lakh. Now just a second before starting a question, and sorry to interrupt you. See, from question number 20 onwards, we are going to do the questions or take the questions on the net asset value. Net asset value is nothing but the total assets minus total liabilities, and that too on the market values divided by the number of units. So we are going to learn how to calculate the net assets. Now from this point, we are going to think from the angle of the mutual fund itself. Till this point, from question number 1 to 19, we were thinking mostly from the angle of the investor who is investing in the mutual fund. But now we will be shifting our viewpoint. That will be the mutual fund from question number 20. Have a look. So there is a mutual fund which raised around 150 lakhs on April 1, 2018. By issue of 15 lakh units at rupees 10 per unit. So these are the basic details to start with. So they raised an amount of 150 lakhs, and that too by issuing 15 lakh unit at rupees 10. So in the beginning face value and the NAV was same. The fund invested in several capital market instruments to build a portfolio of 140 lakhs. Now what we are going to do is question number 20. Let's prepare a cash statement. Cash or bank balance, you can say, or cash account, where the left hand side will be the debit or right hand side will be the credit, or you can prepare a statement in the vertical format also with plus minus plus minus plus minus. Okay, so this is strategic financial management subject. There is no need to prepare a proper account. We should get to know the net balance. So first we raised the cash at fund issued. How much? 150 lakhs. So what are we going to do? We are going to write down figures, all the figures in lakhs. So this is rupees in lakhs. Fund issued how much? 150 lakhs. Okay, sir. 150 lakhs. Now, then what happened? Immediately we invested those funds in several capital market instruments to build a portfolio of 140 lakhs. The entry will be investment account debit to cash account. So the cash account will, this is going into investment 140 lakhs. So practically we have 10 lakh rupees of the balance in cash. Okay. Initial expenses amounted to 8 lakh rupees. During the month of April, the fund sold certain okay, initial expenses amounted to 8 lakh rupees. So let's say initial expenses 8 lakh rupees. We are left with 2 lakh. During the month of April, see from this point, during the month of April, the fund sold certain instrument. Out of that 140 lakhs, we sold certain instruments costing 44.75 lakh rupees for 47 lakh rupees. So this is our capital gain. How much? 2.25 lakhs. So what will be the entry in the cash account? Sold, we can say investment redeemed 47. Our bank account will get debited with 47 lakh. Investment account will get credited with 44.75 lakhs, and the balance will be transferred to profit and loss account. That will be capital gain. Okay. Then, and used the proceeds out of this 47 lakhs, we used that amount to purchase certain other securities for 41.6 lakhs. So additional investment, again I am going to put down the investment account will get debited for 41.6 lakhs. So we have used that 47 lakh rupees. Out of that 47 lakh rupees, we have purchased an investment of 41.60 lakhs. So that's again a cash outflow. The fund management expenses for the month amounted to 6 lakhs, of which 50,000 was in arrears. What will be the entry? The entry will be expense account debit by 6 lakhs, cash account credit by 5.5 lakhs, and outstanding liability by 50,000. So in cash account, I will just write down fund management expenses 5.5, because only this much has been paid out of cash account. Balance 50,000 will go to outstanding liability. Okay, this will be taken into account while calculating net asset value. The fund earned dividends. See, we have invested in the market in the equities. We are the mutual fund. We have put money in the equity so that those companies have paid us the dividend. The fund means the mutual fund earned dividends. They are not talking about the investors who has invested in our company, in our mutual fund. We are talking about the companies in which we have invested. They have given us the dividend. So fund earned dividends amounting to 1.5 lakhs. Okay. So we will write down it in this. We have received 1.5 lakhs as an income. So cash account debit to dividend account. Then, and it distributed 80% of the realized earnings. Now, realized distribution of realized earning. This is going to be interesting. Have a look. Do you think there is only dividend which is a realized earning? No, sir. There are two items. Dividend and capital gain. So dividend is 1.5 and the capital gain was 2.25. Am I right? See, they said realized earnings. Realized earning means something which has been realized, or the profit which has been received in our bank account. So this is not just the only profit of 1.5 lakhs of dividend, but this capital gain is also a profit, 2.25 lakhs, 47, 2.75 lakhs. So let me just correct this. 2.75 lakhs. No. Yeah, it's 2.25 only. I was just confused. Okay, so 2.25 lakhs. Capital gain is also a profit which has been received in the bank account. That means it has been now realized. If we would not have sold these, then this profit would have been unrealized profit. But they are saying realized earning. We have sold the instruments or investments and we have received this profit in our bank account. We will call it as a realized earnings. And dividend of 1.5 lakhs. So these are the two earnings which has been realized by the mutual fund, and the total of it, not just the total, let's take 80% of it has been distributed by the mutual funds. See, mutual fund has distributed these earnings to whom? Sir, it's very simple. These are the investors who have invested in the mutual fund, and mutual fund have invested in the market. Mutual fund has invested in the market. So market paid them 2.25 lakhs and 1.5 lakhs. Out of that, 80% will be paid by mutual funds to the investors, right? So it is distributed. That's an expense to the mutual fund. If this is earning, which we are receiving is the earning which we are paying, the amount that we are paying to the investors will be an expense to us. So 1.5 into 80% comes to 1.20, and 2.25 into 80% comes to 1.8. So this much we have distributed. So we don't have that much of the cash account anymore in our bank account, right? We have distributed 80% of the profit. We have kept only 20% of it. The market value of the portfolio on 30th April 2018 was 147.85 lakhs. This does not attract a cash treatment, right? This is just an asset. Do you understand this? In asset, in the entire statement, there are only two items related to assets, three items, sorry, related to assets and liabilities. Assets is this portfolio, and this 147 includes this 140. Also, it excludes this item which has been already sold by us, and also it includes 41.6. So net amount of that investment that we have made, the market value of the same is 147.85 for all the instruments or the investments that we have made and sold, that we have purchased and sold, I can say. Okay. Now this 147.85 lakhs is the total of, please understand, 147.85 lakhs is the current or the closing market value of all the investments we have purchased and sold. So the items that we have sold will be is already deducted from the net amount of 147. We have included this 41.6 also and this 140. But don't try to do the total of 140, 44.7, 47 and 41.6, because what is given to you is the closing market value, which is obviously not going to match with these figures. And we don't need that also. We need an asset with a market value, liability with a market value. So there are only two assets if you remember in the entire statement. First is the investment, that is 147.85. Second is the cash balance left from this account, if there is any. And the third one is the liability of 50,000 rupees. Apart from that, there is no other assets or liabilities. You can just go through the statement again. No assets and liabilities apart from this. Okay. So, total assets, investment, cash balance, less liabilities. Outstanding liability. So investment is worth 147.85. Let's do the total of cash balance. We will just write it down here. Cash balance. The total of this side is 150 plus 47 plus 1.5. That's 198.5. Minus 140 minus 8 minus 41.60 minus 5.5 minus 1.2, 1.8. So the only balance left is 40,000 rupees. The entire purpose of creating or preparing this statement is to just have a cash balance at the end, which is 0.40. Okay. Less the outstanding liability, which is 50,000 of that fund management expenses. If there is any other asset, add that at market value. Liability, deduct that at the market value. Let's do that. 147.85 plus 0.40 minus 0.50. So the net assets are 147.75. Are you getting it? Let's take that on the next page. So this is the net assets, we can say. Now what to do? Net assets divided by the number of units, closing units at that time. We had issued 15 lakhs units at the beginning, and throughout the month we have not issued anything else. So we have not issued additional units. The closing units will also be same, which will be 15 lakhs. Am I right? Okay. So the NAV at the end, net asset value at the end, will be 9.85 rupees. So that's a loss of 15 paisa, we can say, because in the beginning we had issued, when we had issued all the units of mutual fund in the beginning of the month, it was at 10 rupees, and now at the end of the month, 30th April 2018, this is just a 1 month, the mutual fund NAV is 9.85. So this is NAV 1. Now the question is not asking you to calculate the NAV. The question is asking you to find out the investor's return. Have a look. An investor subscribed to 1000 units on April 1. So at what price he might have invested? At 10 rupees, and disposed it off at a closing NAV which is 9.85 on 30th April. Determine his annual rate of earning. Underline the word annual, because what has been given in the entire question is the per month detail, and they have asked you to calculate the annual earning. Now at the end, when everything is done, you are going to think from the angle of the investors annual earnings. And we have already seen that in the previous question there are three types of earnings. First is the capital appreciation, second is your dividend, and the third one is your capital gain. Have a look. Divided by the starting NAV. Now NAV at closing when he sold his 1000 unit is 9.85. At the beginning when he invested was 10 rupees. Now please focus. The mutual fund has distributed dividend of 1.20 lakhs. Do you agree? In how many units? 1.20 lakhs was distributed in 15 lakhs units. 15 lakh units, right? Also, they distributed 1.8 lakhs of capital gain to 15 lakh unit. Am I right? So the moment you divide by 15 lakhs, the answer will be how much is the dividend and capital gain for 1 unit. Since all the figures are in lakhs, we are going to write down the total number of units also in lakhs, that is 1000. But let it be. We don't need to multiply it right now. We are calculating annual earnings for 1 unit divided by 10. Am I right with this formula? Or let me just write down properly. 1.20 divided by 15, 1.80 divided by 15. What I'm doing is I'm calculating per unit dividend, per unit capital gain, per unit capital appreciation. So the final answer will also be per unit earning annual. Per unit annual earning plus 1.20 divided by 15. So this is 1.5 plus 0.08 plus 0.12, I think. See, every investor out of 15 lakh received a capital loss of 1.50 appreciation, capital depreciation of 1.50, 0.08 rupees per unit of dividend, and 0.12 rupees per unit of capital gain on his investment of 10. But this entire earning is only for 1 month. So what you have to do is you have to multiply it by 12. 12 divided by 1. So this is going to be your final answer. 1.12 plus 0.08 plus minus 1.5 divided by 0.15. Sorry, my mistake. It should be 0.15 divided by 10 into 12 into 100. So that's 6% of the earning. So this is our final answer. See, the question asked us to calculate annual rate of earnings for the investor. So if the question comes in exam, how you should think? First of all, you should write down or the formula in your mind or somewhere else in the rough copy that what will be the formula for investors annual rate of earning. There are only 3 items for an investor: the capital appreciation or depreciation, the dividend, and the capital gain, right? So in this entire formula, when we start thinking, we only have, in the beginning we only had NAV 0, we didn't have NAV 1, we didn't have dividend, also no capital gain was known to us till that time. And then we started doing rest of the parts. We wanted to find out NAV1, and for that purpose, NAV1, for that purpose, we needed a figure of net assets. We had number of units in the beginning itself, 15 lakhs, but we needed net assets. For net assets, you have to have total assets and liabilities. For total assets and liabilities, these are the three items: investment, cash balance and outstanding liabilities, which you had to take it from the first paragraph given in the question. So when the moment you keep reading the question, adjusting the figures, preparing the statement, you will get to know all these three figures. With that, you've calculated net assets, then NAV1, and then this investor's earning. Are you okay with this example? Question number 21 is similar to question number 20. The one thing that you need to understand is where the students are going to make mistake. I will tell you. The students are going to make one mistake where they are going to calculate the monthly earnings, and they are going to finalize that earning itself as an annual earning. So you need to be very careful about the data given for the period for which the data is given and the period for which the earnings has been asked. So this is where you need to be careful. Another thing is the market value of the portfolio. A lot of people will do some kind of adjustment in 147.85. They will just add 140, deduct 44.75, add 44.75, or say add 47, and then they again add 41.6 lakhs. So some kind of treatment they are going to do it, whereas which nothing is required, whereas nothing out of this is required. And a lot of students will try to do some calculation on these investments, purchase and sale, and they will try to find out or to match out the answer, their answer in the calculator with the 147. That is not going to happen because this market value is at the end of the 30th April 2018. You had purchased the portfolio at 140 lakhs at 1st of the April. So obviously the market value will tend to increase or decrease over a period, and it's waste of a time if you are going to match it with the closing value. Another small, we can say, mistake that can happen in this question is that when the question says that 80% of the realized earnings are distributed, most of the students will only take the dividend, because just before this particular statement the dividends details was given. I think the fund earned dividend of amounting to 1.5 lakhs, and it distributed 80% of the realized earning. They didn't say 80% of the dividend. They said 80% of the realized earning. So it doesn't include only dividend. Most of the students will only give treatment of 1.5 lakhs into 80%, and that's it. They will forget about 2.25 lakhs because it was already given, like this treatment was given like couple of treatments back, na? So we are just human and we tend to forget all these things. So that might be the possibility that you will forget about the capital gain. Next thing is, when you calculate the annual rate of earning, you might also forget about giving dividend and capital gain treatment to the investors also, because this realized earning, when distributed, went on to the investor's pocket, right? So you should understand 3 to 4 places where a student can make a mistake. And for that purpose, I will tell you that solving the question beforehand, before watching the answer, is very much important. See, these are the mistakes that I told you that an average students can do. You might be smart enough to do less number of mistakes, and you might be weak enough to do more numbers of mistakes than I have explained in this part. Okay, and for that purpose, in order to know your weakness and strength and where you are standing in the particular concept, you should solve it first. And that's why I keep on putting pressure, or I keep on saying all the time that you should solve the question first and before watching the video. Question number 21 is going to be your homework, sir. Question number 22 is the next question that we are going to solve. Have a look. Now let's have a look on question number 22. A mutual fund made an issue of 10 lakh units of rupees 10 each. That means how much is collected by the mutual fund? 1 crore rupees. On January 1, 2008, no entry load was charged. It made the following investment. See, with that 1 crore rupees, they made this investment. 50,000 equity shares of rupees 100 each, 7% government securities, 9% debentures, 10% debentures listed, unlisted. And the total investment that they made is 98 lakh rupees. And this is where a student will make a mistake. He will forget about how much is collected. He can just remember that 98 lakh rupees is invested. With this information, you can get an idea that 2 lakh rupees is still lying in your bank account, which is not presented anywhere here. So that's also an asset you should remember while moving forward. Okay, let's go ahead. During the year, the dividends of 12 lakh rupees were received on equity shares. Okay, this is going to add our cash balance. So 2 lakh plus 12 lakh, 14 lakh rupees were received on equity shares. Interest on all types of debt securities was received as and when due. See, if we talk about the income from every type of investment, we received 12 lakh rupees on the investment of 80 lakh rupees in the equity share. And then debentures interest and government security interest is also received as and when due. So 7% on 8 lakh, 56,000. 9% on 5 lakh, 45,000. 10% on 5 lakh is 50,000. So if you talk about the total income that we have received, 12 lakh plus 56,000 plus 45,000 plus 50,000, that comes to around 13 lakh 51,000. Okay, so the entry will be cash account debit to income, right? 13 lakh 51,000 rupees. And we already had 2 lakh rupees of the cash balance in the beginning. So the total cash balance now is 15 lakhs 51,000 rupees. That's an asset. Investment is 98 lakh rupees. But this value is not relevant to us. Why? Because this is the value at the beginning of the month, January 1, 2008. While calculating NAV at the end of the month, we need the market values of all the securities, closing market values. So the information of that is given here. See, equity shares and 10% debentures are quoted at 175% and 90% respectively of face value. This is very important. So have a look. They are talking about these two things. 10% debentures and 50,000 equity shares are quoted at 175 and 90%. See, so if you take 175% of 100, it becomes 175 rupees into 50,000. That goes to 87 lakh 50,000 rupees. This is the current value of the equity share, and debentures are listed at 90% of the face value. What is the face value in this question? It is not specifically mentioned. So 5 lakh itself will be considered as a face value. Okay, so 90% of that will be 4 lakh 50,000. So this is the current market value. Let's talk about rest of the two. If there is any other information about that. Other investments are at par. That means both the other investments are having same value. They might not be traded in the market, so 8 lakh and 5 lakh will remain same. Now the closing market value of all the investments that you have made is like this: 105 lakhs, right? So if you look in the balance sheet of the mutual fund on the asset side, just imagine investments will be showed at 105 if we talk about the market value, and the cash balance will be 15 lakh 51,000. So this is investment and this is the cash balance, 15 lakh 51,000. And now if there is any type of outstanding expenses, or if there is any expense which is reducing the cash, we are going to give that treatment. Let's read further. Find out the net asset value per unit given that the operating expenses paid during the year amounted to 5 lakh rupees. So to that extent, 5 lakh rupees of the cash balance will get reduced from 1551. So what are we going to do? We are going to reduce 5 lakh rupees. That will bring down the cash balance to 10 lakh 51,000. So ultimately the net assets, there is no liability, right? The net assets will be 10 lakh 50,000 and 10 lakh 51,000 of the cash balance. Have a look on this side. Am I right? 15 lakh 51,000 was the cash balance before deducting operating expenses. Once you deduct that, the net balance is 10 lakh 51,000. This will go directly to the calculation of net assets. And after that, these are the total investments to you. This is going to contribute around 105 lakhs. And when you add this 10 lakh 51,000 to 105 lakh, the total will be this net assets. We can call it as a net assets. There are no liabilities, so that's why we are not deducting anything. Net assets divided by the number of units that you had issued, which is 10 lakhs, and this is the closing NAV, 11 rupees 55 paisa. Closing NAV. So the first answer is 11 rupees 55 paisa. Now let's come to the second part. Also find out the NAV if the mutual fund had distributed a dividend of 0.80 per unit during the year. And it's very simple. If they are distributing something, then the cash balance per unit will get reduced by 0.80. 11.55 is also per unit. This is also per unit. You can calculate the new NAV as 11.55 minus 0.80, which will come to 10.75 directly. Otherwise also, if you go with the logic, 0.8 into 10 lakhs is the number of unit. That means 8 lakh rupees of the dividend has been distributed by you, which will reduce this cash balance by 8 lakh rupees. And the balance will be 2 lakh 51,000, which will come to this part, which will get added to this thing. And the total net assets will be at that time 2 lakh 51,000 plus 105 lakhs. So the net assets will be 105 lakhs plus 2 lakh 51,000. So the net assets will be 1075 1000. Okay, divided by 10 lakhs, 10.751. It was also coming to 11.551, I think, and the final amount will be 10.751. So you consider it this way or that way, the answer will be same. And I think in order to reduce the calculation, you should follow this approach. But obviously the very first thing is to understand the concept. So it's very simple. If you distribute 8 lakh rupees, it will reduce the cash balance. This will reduce the figure here. This will reduce the net figure of the net assets. When you divide it by the number of unit, the total value will get reduced. And the shortcut is this. As you had already calculated, 11.55 was the per unit NAV. 0.80 was also distributed by per unit. So if anything is going out of the mutual fund per unit on a per unit basis, with that much of the amount, NAV will get reduced. So that's the closing NAV, right? 10.75. Now question number 23 is your homework. You are going to do it. It's very easy. Question number 24 is what we are going to discuss. Let's have a look. Now there is an ACE mutual fund has the following assets under it on the close of the business. See, this is a mutual fund already, and there are 4 companies in that. Number of share into market price, if you do that, you will get the market value on 1st of August 2019. Right? So let's do it. 2000 into 200, that's around 4 lakh. Am I right? Then 312.40. I think they have done it here as well. They didn't do calculate this one. Okay, let's do that. 312.40 into 30,000, that's 93 lakhs, 72,000. Then 40,000 into 180.60, 7224. Then 60,000 into 505.10, that's 3 crore 3 lakh 6,000. So if you do the total, it comes to 473,02,000. So that's the net assets on the very first day of August 2019. There are no cash balance, there is no liability, nothing in the assets and liability column except for this is given. So this will be treated as the net assets divided by the number of units, which is 6 lakhs. And you will get the first answer, which is calculate the net asset value per unit as on 1st August 2019. 473 divided by 6 lakhs, and that is your net asset value on the very first date. Now let's come to the second part. Following information is given. Assuming that Mr. Tarun, he is an investor. He submits a check of 30 lakhs to the mutual fund and fund manager of this entity purchases 8,000 shares of R Limited. And when did he submit all this information? On the very first day of August 2019. Basically, it means that Mr. Tarun is investing in the mutual fund, right? So by paying 30 lakh rupees, this is Tarun, this is mutual fund. Tarun has given them 30 lakh rupees, and in return he will get the number of units at NAV of that date, which is calculated here. So he is buying every unit at 78.84 rupees, and he has paid 30 lakh rupees. Okay. Now, what the fund manager has done with that 38 lakh rupees is he purchased 8,000 shares of R Limited on the very first day at this price of 312.40. So if you do the calculation, 8,000 into 312.40, it comes to 24,99,200, and the amount that Mr. Tarun paid was 30 lakhs. So the balance amount of 5,800,000 is still lying in the bank balance of the mutual fund now. So mutual fund invested around 24,99,200 in R Limited. So we can say 8,000 shares has been added more in the portfolio for R Limited. Now think from the angle of the mutual fund and investor. 30 lakhs divided by that day's NAV will be the additional units mutual fund has issued to Mr. Tarun, and that will get added to 6 lakhs. This is an open-ended fund. That means if today the units are 6 lakhs, that doesn't mean that it will remain 6 lakhs forever. Open-ended means they can issue new funds, new units anytime they want. It's not like equity share. For equity share, in order to increase the equity share, you have to come up with a particular resolution, IPO, and everything else. Like if you want to split it, you have to give notice to the SEBI. You have to come up with a resolution also. If you want to split a one share into 10, right? Also, if you want to come up with a new shares in the market, then you have to come up with this IPO thing or further public offer, etc. But in open-ended mutual fund, anytime you can issue new funds, new units. So 30 lakhs divided by 78.84, if we do that calculation, you will get something. That means around 38,051.75 units were issued additionally by this mutual fund, and 6 lakhs was the opening. That means 6,38,051.75 was the closing units of mutual fund on the very first day. And this will not change the NAV because net assets has been increased by 30 lakhs and the units has also been increased worth 30 lakhs. So even if you divide and calculate the NAV on the same date after this transaction, it will come to the same figure. See, the question is saying what would be the position of the fund now? Have a look now. You have the Q Limited, S and T Limited as it is. Okay, but R Limited has changed from 30 to 38,000, from this figure to 1 crore 18 lakh 71,000. So the net assets has been increased. Yeah, the net assets has been increased to 5 crore 3 lakh 2,000. Earlier it was only 4 crore 73 lakhs. Now it is 5 crore 3 lakhs. And you can clearly see this is the cash balance, 5 lakh 800. You can clearly put a mark here to show how this has been calculated. 5 lakh 800. If you do calculate the NAV on that date, it will still come to the same figure as 78.84, because on the denominator side, the number of unit has increased worth 30 lakhs. Net assets has also increased in the numerator worth 30 lakhs. So numerator and denominator has we can say equivalently increased, and that's why the figure is same. See, 30 lakhs rupees minus 8,000 into 312.40 worth of R Limited shares has been purchased. So out of this 30 lakhs, this much amount will go to R Limited and the balance will go to cash account. The number of units is 6,38,051.75. What they have done is they have rounded off the number of units, but in practical life the number of units can be issued in decimal as well. So even if I writing 638,051.75, this is true when I'm writing the units of mutual fund, but this will go wrong if these are the equity shares of some company. Equity shares cannot be distributed in decimal, right? But units can be. So keep that thing in mind. Now find out the new NAV as per unit as on 2nd August 2019. The very next day the prices of all the shares has changed, and the only thing that you have to do is make this 30 to 38,000, multiply it with the new prices and add the cash balance that you have now before calculating the net assets. So it's very simple. See, what are you going to do? You just make 30 to 38,000 are limited, rest of the number of shares are same. Change all the prices, calculate the new net assets, add cash balance, and the net assets now on the next day, on the 2nd of the August, is 5 crore 24 lakhs 86,000 divided by the new total number of units, that is 6 lakh 38,000, and the new NAV will be 82.26. That's easy. That's pretty much easy. The second part was the main thing for which we took this question. Did you understand this question? It's very simple. Except for the net investment and the cash, there is no other assets. If there would have been liability, we would have deducted it. If there would have been any kind of other asset, we would have added it, but there is nothing else, and that's why we are sticking to the basics. So this was question number 24. Now we are going to solve question number 25. From 25, see, I will tell you 25, 26, 27 and 28 and yeah. So next 4 questions are pretty much similar to each other. I will be taking around 2 questions out of it only, and the rest of the 2 will be homework because they are pretty much simple. The easier one will go to the homework part and the difficult one will be taken by me in the class. So let's take a break of 5%. I will be back with question number 25.